Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. It's a truncated week again here in India, but the narratives coming along is nothing new. Friday's labor market data from the US continues to indicate a tight labor market with unemployment rate falling. This is something the Fed is watching closely as the overall economy continues to print resilient numbers. RBI's meeting was no surprise either. And morning, Jacob, this week's focus will be on the ECB meeting. We saw the Swiss pivot. Do you think we can possibly see a surprise rate cut by the ECB as well?
I'm very much doubtful, Swaraj, because if you go by even the dovish members' statements from ECB, they are not likely to cut before June. In fact, one of the members actually said that we are watching the Fed. So unlikely that, unless Fed postpones its rate cut beyond June, UCB will not be cutting ahead of Fed. That is the sense that we are getting. And of course, Eurozone economy also, besides the inflation being lower steadily, economy is also improving. So that also gives them some space to wait and cut the rates. So I'm not expecting a surprise this week, to answer your question shortly. But then, as far as US economy is concerned, the story is not changing at all. It continues to be, US exceptionalism, and apart from the GDP data and factory numbers that came the previous week, we had the job numbers, which was super strong, is on Friday, coming at 3,03,000, market expecting 2 lakhs, unemployment rate coming at 3.8% versus 3.9% that was expected. So the report not only highlights the US labor market's remarkable resilience in the face of high interest rates and inflation. Of course, it also shows some, mild wage inflation pressure easing. But while that can be a positive news or welcome news for the Fed, the economy, has added 39, jobs, added jobs for 39 consecutive months, making it the longest period of job expansion on record. Unemployment rate has been below 4% for 26 months in a row. That's the longest streak since the late 1960s. So it's a super strong economy still, and inflation is not easing. All this is giving discomfort for the Fed members who have been very, very vocal in their expectation, or in dousing the expectation of the market on interest rate cuts. And in fact, there are some even Wall Street analysts who are now doubting whether Fed will actually cut 3 times. The extremes, of course, going towards even a hike in December, but that's too early to say, because we have to see how the inflation and the economy performs, because the economy at 5.5% is unlikely to perform for more months or one more year in the same pace. So more and more Fed members, like, you have Lori Logan, who said, I'll need to see more uncertainty resolved, without which economic, about which the economic path we are on, and therefore not in a hurry to cut rate. Bostic also said that he favored one more rate cut this year, and not until the final 3 months, just one more rate cut, he said. Kashkari, of course, had already said that, he had raised the possibility that Fed might not cut the rate at all. There was one more member, Loretta Mester, who said that it depends upon whether inflation will resume its fall back to the central bank's 2% target. So you have hardly any members supporting a early rate cut. So this has actually pushed the yields across the tenor 2s to 30s higher. And why not? Because you have the say Treasury looking to borrow more, and yields, inflation not coming down, economy performing strongly. Nobody wants another surge in inflation if Fed were to cut early. So that's a scenario as far as the US economy is concerned. The US stock market, of course, celebrated the better jobs report than, giving up gains on the basis of higher yields or lower probability of a rate cut. Now, actually, the Fed Watch tool shows in fact, it is below 50% probability of a rate cut in June. So that's a big come down. from high 70s or even 80s that we had seen on the probability side. So US market, of course, gained back the big losses, some of the big losses that they had incurred on Thursday. This was more in reaction to economy proving resilience. Of course, the whether markets can sustain these levels in the face of perception of overvaluation depends upon how the corporate earnings come in the coming month. We are already into April, and we will start getting corporate earnings reports in a couple of days. How the economy or how the corporates have performed in the face of high interest rates and high inflation is something that will determine the market's direction. Currencies, nothing much actually, because the super resilience of US economy has not really been reflected in the dollar. Dollar is in fact unable to build on the gains that it has been trying to make, and particularly on the euro, we have seen very uh, impressive bounces from 0.7 levels. We were expecting it to break 0.7 based on a lower eurozone inflation, stronger GDP number from US, but that did not happen. It does appear that market wants to have more of euro, or they are underowning the euros. That's one possible explanation. Also, if you look at the rally in gold, you can also see that market is buying less and less of dollar reserves than of other reserves. So it's a slow diversification that we are seeing into gold, and also perhaps to some extent into euro and other currencies as well. So the dollar is not giving any direction. It is at best in a range for the timing. Of course, we will watch the dollar yen, because once again, it's not giving up. Its attempt to break 152 and invite and see whether it invites actual intervention action from the Bank of Japan. We have the yuan also closer to, yuan fixing also closer to its highs at 7.0950. Also watching the yen movements in the market. So nothing much as far as the dollar is concerned. Still very rangy. Dollar rupee made some gains after continuous attempts to break into new lows, but consistent offers from central bank at 83.45, and some longs bailing out particularly after the deadline for implementation of the circular of Jan 2024 on exchange traded derivatives has been postponed. So that some relief to the market, and we had seen the dollar be easing to 83.30 or slightly below right now. Unlikely we break 83.20, because there is a lot of importer interest at those levels. And don't forget that oil is trading at multi-month highs and technically looking to establish more gains. So that's it for now. We see you on Wednesday. Thank you.
Thank you, JK. And of course, the ECB meeting will be in limelight this week, and it doesn't look like ECB will be cutting rates ahead of the Fed. US exceptionalism continues, labor market resilience, as well as the projection of three rate cuts this year. That's coming into doubt now, as the US economy continues to fare well, including the tight labor market. Now the focus will, of course, be on the earnings season as well from the US stocks. Gold has rallied really strongly with the recent move about 2300. And for rupee, we made some gains. 83.45 was well protected, but 83.20 remains a good level with a lot of importer interest. That's it from us today. Thanks for listening. Tune in on Wednesday for the latest updates in the financial markets.